The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Europe with Ben Boulos and myself, Steve Sedgwick, and these are your headlines. A 10-day ceasefire between Israel and Lebanon taking effect, whilst President Trump says the war with Iran should be over pretty soon. Israel's central bank chief telling CNBC he expects a deal but won't take anything for granted.
It's a working assumption, and that's why I've used that language very carefully. I think there's huge uncertainty around it.
Equity markets hitting yet more record highs, especially stateside, as investors hope for peace in the Middle East. The Nasdaq on pace for its best week in a year. European benchmarks more mixed on the week, though.
Spain's Deputy Prime Minister Carlos Cuerpo tells CNBC at the IMF Spring Meetings the government has no regrets over its refusal to get involved in the US war with Iran, a war he stresses breaks international conventions.
Spain did not want to participate in this unilateral conflict that is outside of international law, and that's actually what we did. The Spanish government is taking actions to avoid active or passive participation in this conflict.
Europe's central bank chiefs insist they remain in wait-and-see mode ahead of a crucial rate meeting in less than 2 weeks. France's Governor François Villeroy de Galhau says the ECB must not rush into any decision.
We are not in a precipitation mode. We need to reach a sufficient level of data about the effect of on underlying inflation, second one, and also the negative effect on demand and growth.
What extraordinary moves we've seen on these markets. Really pricing out all bad news options and scenarios from these talks that have been going on directly and indirectly between Israel and Lebanon, the US and Iran as well. The markets have just gone gung-ho to the upside, and yet we're still in such a tentative position. I do wonder what that means. A 10-day ceasefire, though, between Israel and Lebanon is in place, with the US president saying the country's leaders will meet for talks likely at the White House in the coming weeks. Mr. Trump said the ceasefire includes Hezbollah, adding he hopes the group, quote, acts nicely. The president also addressed the war in Iran, saying it is going along swimmingly and reiterating his expectations that the conflict will soon be over. Trump was asked whether he was considering extending the current ceasefire.
We're doing very well, I can tell you. Maybe it'll happen before that. I'm not sure it needs to be extended. Just so you know, Iran wants to make a deal, and we're dealing very nicely with them. We've got to have no nuclear weapons. If we do, that's a big factor. And they're willing to do things today that they weren't willing to do 2 months ago.
Dan, it comes to you and I on a daily basis to interweave the economics, the business, the geopolitics and the markets. And I personally am struggling with the market reaction at the moment. The market thinks this war is over. I don't know if it feels as clear-cut to anyone in the Middle East.
It's a really good question, Steve. And I think over the last couple of weeks, we've seen this repricing ultimately start to take effect. If you were trading oil, you were much more hawkish on the scenario about 2 weeks ago when we saw prices in triple digits. If you've been trading equity, you have been pretty calm about this situation for most of the run through. And in fact, that calmness now turning to euphoria, given the fact that we've seen Wall Street outperform over the last 10 or 11 sessions and the record-setting rally that we've seen in the last 2 sessions as well. So it seems as if for the equity markets, the war is over. For oil markets, well, maybe this still has a little while to go. Two major developments to update you on overnight, and the first is in Lebanon, where a ceasefire with Israel took effect at about 1 o'clock this morning Gulf time. This is the first halt in major fighting there in nearly 7 weeks. And President Trump has invited both Prime Minister Netanyahu and President Un to the White House for direct talks. But whether that happens remains to be seen. And as we've been discussing, inside Lebanon, obviously quite a complex situation on the ground. The Lebanese army has already reported Israeli violations of that truce. So this seems quite fragile from the start. And then, of course, inside Lebanon, the bigger issue is, of course, Hezbollah, which is not at the table here. And without that group, any deal is built on shaky ground. The Lebanese government simply doesn't have the military capacity to enforce a peace that Hezbollah opposes. And this is important because Iran had insisted that a Lebanon ceasefire was a precondition for nuclear talks with the United States. That box seems to be now checked, at least on paper. President Trump is claiming that Tehran has already agreed to surrender its nuclear material and reopen the Strait of Hormuz. Iran hasn't confirmed either, but a second round of US-Iran talks in Pakistan is now reportedly being discussed for as soon as next weekend. And then, of course, for oil traders, you also have to look at the situation inside the Strait of Hormuz for insights and clarity on the direction of travel here. The US naval blockade remains in full force. We've seen 14 vessels intercepted or turned back in the last 72 hours. So the situation there also seems calm and the ceasefire is holding. The big question now is whether the Lebanon ceasefire holds and whether this unlocks a broader deal, perhaps the most important question for traders to be contemplating as we close out the week.
Excellent work, Dan. Thank you very much indeed for that, Ben.
Well, at the IMF World Bank Spring Meetings, Karen asked the Bank of Israel governor whether he expected the Middle East conflict to end soon.
It's a working assumption, and that's why I've used that language very carefully. I think there's huge uncertainty around it. We could see a situation where indeed we see agreement and we see a positive, sustainable situation in which the geopolitical risk on Israel, but also on the Gulf states, which also have gotten the grunt of the Iranian aggression, and we see a really de-escalation of this geopolitical risks for a pretty sustainable long-term period, and in that sense, if that happens, we'll see a much more improved growth rate. And there's obviously a situation where this thing's prolonged, and that will weigh on both inflation and growth.
Well, Karen's been getting the latest reaction from Europe's top policy and lawmakers at the IMF World Bank Spring Meetings in Washington. She asked Spain's Deputy Prime Minister Carlos Cuerpo how the country views the macroeconomic impact of the Iran war.
That Spain is actually better prepared than on other occasions. In economic terms, we're the fastest growing advanced economy in 24 and 25. We've been creating 40% of all new jobs in the Eurozone, and we just represent 10% of the Eurozone. On budgetary
40% of the jobs in the Eurozone?
Yes, last year. And we, on budgetary terms, we're also better prepared. We had primary surplus in 2025. In terms of debt, we're back to pre-COVID levels almost. So we've rebuilt the buffer that we used to respond to COVID and Ukraine. And in energy terms, we're also better prepared because we've pursued our agenda on renewables. And just to give you a figure, in 2019, 75% of the hours, electricity prices were determined by gas in Spain. And in 2026, it's just 16% of the hours. So it kind of increases our energy sovereignty and reduces the exposure to the shock. But in any case, we're still suffering the consequences, for example, in terms of higher fuel prices for our citizens, for our firms, and in particular those sectors that are more dependent on energy consumption as well, and fertilizers. And this is why we did put in place on the 20th of March already a first specific plan to help firms, help citizens, 5 billion of direct support, plus 2 billion in terms of also loan guarantees for our firms. Let's see how much is needed, because there's huge uncertainty, but somehow we're already preparing and protecting our citizens.
The Iran conflict has led to more conflict between the US and Spain. Trump now openly hostile against Spain after your Prime Minister Pedro Sanchez has pushed back against the US of Spanish bases, the criticism against the war itself, and of course the pushback back against defence spending. What is the risk of antagonising the US to the extent where it impacts the trade relationship?
Well, somehow those decisions have been taken on the basis, each and every one, of the specific case that we were analysing, and Spain did not want to participate in this unilateral conflict that is outside of international law, and that's actually what we did. The Spanish government is taking actions to avoid active or passive participation in this conflict, and this is not to antagonise anyone, it's just our own sovereign position on this fact.
That said, Trump over the course of the last few weeks has threatened a trade embargo against Spain. Is that a threat given you have the wrapper of the European bloc around you?
Well, we're not alone in this position against the current situation and the participation in the war in Iran. Many other European countries and partners have also expressed a very similar position. And when it comes to trade relations with the US, Spanish companies operate in the exact same environment than French, German or Italian ones, because we have a unique trade relation, within the EU with respect to the US, and we're trying to go ahead with a deal that we signed last August, and that's actually where we should put all our efforts to be able to fulfill that deal and make good on it, so that we give predictability to our companies, which is what they're looking for.
Skeptics have questioned the Prime Minister's position around the Iran war, whether this is just manoeuvring for some political gain at home. What would you say to those critics?
Well, in Spain we were in a very similar position more than 20 years ago with the war in Iraq. And I think we've all learned a lot from that experience in Spain, and there is a strong support from the population to the position of the Spanish government, and there's a clear message of no to this war, and that's actually, I think, what is making the Spanish position even stronger, because we have somehow a very cohesive response to this situation. No to the participation of Spain in this war, and that's a message that resonates with our population as well.
Where do I start on these US markets? Well, I'll start with one that's not even on the screen. The Dow Transports, week to date, if any of you don't know, what do you think they're up? 7.3%. Nasdaq's up 5.2% week to date. S&P's up 3.3%. Is this rational given everything we're worried about? I don't know. Let's ask Michel Lerner, who is head of Holt UBS. Michel, I thought the nuttiest story of the week would be this row between the Catholic Church and Trump over pictures of him that may or may not have him looking like Jesus or have him looking like a doctor. I'm not getting involved in that. But no, as far as I can see, the nuttiest story of the week is the fact that a shoe company thinks they've spotted a window in AI that no one else has spotted. And not only did the market not laugh at them, but they sent their shares up hundreds of percent and then down again. Are we really getting to anywhere closer to working out who the winners and losers should be in this market, rather than the market just going off at vast tangents?
Yeah, look, Holt is a framework that provides a reference to history relative to where valuations and corporate performance are, so we can ask questions. We certainly won't have the answers to that question. What I will say is, when we look at where valuations are at today, increasingly investors have to ask themselves whether it makes sense for these valuations to be anchored around the very expensive levels that we've got accustomed to in the last few years, and certainly the last few weeks again, or whether the litany of risks that are now on the table, AI, geopolitics, inflation, whether that actually requires a rebasing down of expectations. And it really just gives a framework to what your question is, but I think the risk reward as we look at our data is more firmly to the downside than the upside if we look through the short term.
See, I don't have a problem as such with people saying, even if Nvidia was trading at a crazy multiple, which is, funny enough, it's not. It's one of the few stocks that's not. Because you can see a route to that valuation being justified. We all look at a 1-year PE, but let's have a look at a 2-year PE, or look at a further increase in sales a bit further out. So if I can see the route, that's fine. But there are so many companies where I don't see the route, and yet I see mad valuations. And that's where maybe your very, very precise analysis may help us.
Yeah, so let me give you a bit of context with numbers. I think for the better part of 50 years, market valuations in the US, but also in Europe, would typically trade in a Holt PE of about 15 to 25 times. And in the last 10 years, we've talked about 25 to 35 times. So there's been a whole rebasing up in numbers. And in my mind, that made sense in a world where you had accommodative central banks, you had low inflation, you had very predictable operating environments for companies without the threat of AI. That is arguably somewhat different today. And yes, there's some very well-run businesses that have a good short-term trajectory, but the question is still, what will be the ROIs through cycle? Do they still show upside on normalized growth assumptions, normalized ROI assumptions, and normalized cost of capital assumptions? And I think, in that regard, it can be sobering, even for the likes of the semi-businesses.
Let me stop you right there, because you've come on to the next thing already, which I'm fascinated about, which is normalized cost of capital assumptions. One investor's normalized cost of capital assumption is very different from another's. And given the fact that everything that's happened over the last 12 months and a bit, whether it be from tariffs, whether it be through these devastating conflicts as well, says to me that the cost of capital won't necessarily be as cheap as some people think it should be on a normalized basis. Just address that for me.
Yeah, and this is absolutely the point, is in a world where you had low rates, it made sense for a lot of these businesses to be bid up, particularly long duration stocks that benefit from a low rate environment. If we look where bond yields are at today, versus equity valuations, we have an equity risk premium in the US that's close to zero. There's an inconsistency in that. One way or the other, one of the asset classes has to rebase.
Yeah. Michelle, just sort of taking a step back and looking at the way everything is kind of sitting at the moment in terms of the different assets, to me, it sort of doesn't make sense. If you've got the S&P and the Nasdaq at record highs, gold is up. It's not far off. It's not quite at its record highs, but it's up. Oil is up, suggesting we've got inflation coming down the track. Aside from that, the fertilizer prices and the impact that's going to have on food prices and inflation. The dollar's down and bond yields are up. It feels like things are stacked in such a way, like a Jenga tower, that at some point, someone's going to realise that actually this doesn't logically make sense. Which is the most accurate guide as to the reality? Is it the oil price? Is it the equities price?
Look, it's incredibly difficult to say. Again, I go back to history, and we see the markets can remain irrational for a very long time. Recall Alan Greenspan's speech on irrational exuberance in 1995-96. Had you actually acted on that, and he was absolutely right, valuations were as expensive as anything we had seen since the 1960s, but had you acted on that, you would have missed the biggest bull run on record. So we have to be aware of the risks, and there's no doubt that, again, if we look at the Ps I mentioned, relative to history, things are very, very finely balanced. What it means is, in the short term, markets have been willing to chase stocks that have a good narrative. And so it's been very much all about momentum stocks. So, if you have names that have high and improving ROIs with good revisions, investors have sat comfortably with that despite the valuation concerns. But more broadly, absolutely, I hear you. It's very, very difficult to find names that have through-cycle valuations that make sense on more normalized assumptions.
In which case, if an investor were looking for where to spot the alarm bells or the canary in the mine, and whichever analogy you want, where do you think we're going to see that first inkling of things maybe, if they do come unraveled, things start to sort of teeter?
Yeah, and look, by definition, we won't know until we do, and that's part of the problem. Valuations have to be a red flag because it ultimately means that your conviction levels have to be that much higher that companies can grow into their valuations. And, Steve mentioned, some of the semi names that have really attractive short-term Ps. The reality is you also have to look through that. The ability to reinvent a business model through multiple product cycles, in theory, is something that should be captured in a DCF. And again, and I'll come back to the same points, if you do put, if you put normal through-cycle assumptions on growth, it will be incredibly difficult for most of these names to justify their valuations. Just to give you a sense, any high-growth business normally will see its growth fade to about 5% in 5 years. High growth, superior growth is incredibly difficult to maintain. If I use that kind of base rate, even for the exceptional businesses today, you simply won't get upside.
Just one quick one. Having a conversation with a long-term correspondent, market practitioner, Tom, in the last 24 hours about the effect of the money that just comes into the market from 401k on a regular basis and why we're bouncing so aggressively. And maybe the answer lies in that fact that there is just such a flood of new money, monthly basis, annual basis, coming into the market. Combine that with share buyback, which is a de-equitization. the pool is getting smaller. Does that help answer the question?
Yeah, and look, a lot of our institutional investors ask about that, and we can't capture that per se, but there's no doubt that retail flows possibly play a role in that. You would see it on the up, but in theory, you would also see it on the down potentially. If we look at some of the data that we have looked at retail holdings, and typically they correlate very closely with valuations. So in other words, when markets are at peak, typically retail holdings are also at peak, and today they are right back at dot-com peaks, right around 70% in the US. So take that potentially as a warning sign as well.
Gosh, there's a few out there, isn't there? Michelle, lovely to see you. Thank you very much indeed for joining us. Have a wonderful weekend. Michelle Lerner, who is the head of Holt Analysis at UBS. We always learn something. Thank you.
Thank you.
We'll be learning more right after the break, because coming up, a slew of central bankers weigh in on the impact of the war in Iran and how it could affect the rate path ahead. We'll bring you Karen's interesting conversations from Washington, D.C. Plus, Netflix shares fall in after-hours trade, with the streaming giant announcing the departure of its chairman. And we'll talk all things big tech and AI with Lead Edge Capital's Mitchell Green. That conversation coming up for you later this hour.
Lovely. Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
Business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that a society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this. Welcome back. The fallout from the Iran war on Europe has been a key topic in conversations at the IMF World Bank meetings in Washington, D.C. this week, where Karen has been speaking to a host of ECB officials. Banque de France Governor François Villeroy de Galhau said the war has caused unprecedented uncertainty.
We don't know yet, to be honest. It's why we at the ECB published 3 weeks ago 3 different scenarios, and this is exactly what the IMF did here this week. And let me stress that we cannot bet only on the most favorable scenario, so-called reference scenario for the IMF. We must be prepared for each of these scenarios, because there is unprecedented uncertainty, even unknown. It could be prolonged. There could be secondary effects, not only on energy, but also on some other products. So in our case, we expect higher inflation, and we expect lower growth. In each of these scenarios, the euro area, as well as the French economy, would avoid recession. But clearly, this is a negative supply.
But stock markets are pricing in a swift resolution to the conflict. If we look at what the S&P 500 has done this week, back to record highs, suggesting that investors are optimistic. You're saying there will be legacy impacts even if the war was solved tomorrow.
We cannot bet only on market expectations, and they are more linked to what I call the reference scenario. So we all hope for the better, so to have a truce, a peace, with a strong resolution, a strong reopening of the Strait of Hormuz, and a strong reopening of production capacities in the Gulf countries. But we all know that probably the reality will be a bit more difficult, a bit darker, so we have to be prepared to any possible scenario.
It feels as though the implications from the conflict are going to wash across Europe in waves. What data are you watching very closely, and what's the time frame for seeing any big impact for Europe?
So let me stress perhaps 2 things in this unknown environment. First, the starting position is better than in 2022 because we have much less inflation. We have won the battle against inflation, and we have much less inflationary pressures on demand, supply, or on wages. And the second thing is perhaps to precise not exactly how we will act, this is too early to tell, but how we think. We as central banks are not responsible for the first round effect, energy prices or some prices of products which are directly impacted, like plastics, fertilizers, helium, and so on. but we are responsible to prevent possible second round effect to services, manufactured goods and wages. So let me be extremely clear about the KPI we will look at. We will look at wages, we will look at inflation expectations of households and firms, do they remain anchored, and we will look at underlying inflation. So far, if I look at the last figures published yesterday in the euro area, headline inflation increased significantly in March, 2.6%. This is a first round effect of energy. But core inflation, without energy and food, remained limited and even slightly decreased at 2.3%. So we will act without hesitation if needed and when needed, but we are not in a precipitation mode. We need to reach a sufficient level of data about the effect of on underlying inflation, second round, and also the negative effect on demand and growth.